In 2001, a single company's collapse erased $74 billion in shareholder value overnight. 7 years later, another firm's bankruptcy triggered a global financial crisis that cost millions their homes. And in 2008, one man's lie stole $65 billion from thousands of investors, including Holocaust survivors and charities. These weren't isolated incidents. They were earthquakes that reshaped the entire financial landscape. Today, we're uncovering 4 financial scandals that didn't just destroy fortunes, they changed the rules of money forever. Welcome back to Financial Mysteries. Before we dive into the chaos, you need to understand something critical. Every scandal we're about to explore shares 3 deadly ingredients. First, unchecked ambition. Leaders who believed they were untouchable. Second, regulatory blind spots. Watchdogs who were either asleep or deliberately looking away. Third, a culture that rewarded deception, where cooking the books became standard practice. The financial world has always had rules, but what happens when the biggest players decide those rules don't apply to them? Let's start with the scandal that rewrote corporate accountability forever. December 2001. Enron, America's 7th largest company, filed for bankruptcy. But this wasn't a simple business failure. This was systematic fraud on an industrial scale. CEO Jeffrey Skilling and Chairman Ken Lay had built an empire on lies. They used something called mark-to-market accounting, a legal loophole that let them book projected future profits as current revenue. Translation: they were counting money they hadn't earned yet. And when those profits never materialized, they hid the losses in shell companies with names like Chuco and GDI. The result? 20,000 employees lost their jobs and life savings. Shareholders lost $74 billion, and Arthur Andersen, one of the Big Five accounting firms, was destroyed for shredding evidence. But here's what changed forever. Congress passed the Sarbanes-Oxley Act in 2002. CEOs could no longer claim ignorance. They had to personally certify their financial statements, under penalty of prison time. Enron didn't just fall, it forced the system to evolve. Now let's rewind 281 years earlier, to 1720, London. The South Sea Company promised investors unimaginable wealth from trade with South America. There was just one problem. The trade barely existed. Company directors bribed politicians, spread false rumors of gold and riches, and artificially inflated their stock price from $128 to over $1,000 per share in just months. Even Isaac Newton, yes, that Newton, invested $20,000. When the bubble burst, he lost the equivalent of $3 million today. He later said, "I can calculate the motion of heavenly bodies, but not the madness of people." Thousands were ruined, suicides spiked, and Britain's government nearly collapsed. The aftermath? Britain passed the Bubble Act of 1720, one of history's first securities regulations. It banned unauthorized stock offerings and required companies to get royal approval before going public. This 300-year-old scandal created the blueprint for modern financial regulation. Every securities law since traces its DNA back to this moment. September 15, 2008. 3:30 a.m. Lehman Brothers, a 158-year-old investment bank, filed for the largest bankruptcy in U.S. history, $613 billion in debt. Gone. But this wasn't just another corporate failure. Lehman's collapse triggered a global financial crisis that destroyed $10 trillion in wealth worldwide. How did it happen? Subprime mortgages. Lehman had gorged itself on risky home loans, packaged them into complex securities, and sold them as safe investments. They used something called Repo 105, an accounting trick to temporarily move $50 billion in debt off their books before quarterly reports. When housing prices crashed, the house of cards collapsed. Banks stopped lending. Credit markets froze. The global economy nearly flatlined. Unemployment hit 10%. Millions lost their homes. retirement accounts evaporated. The response? The Dodd-Frank Act of 2010, the most comprehensive financial reform since the Great Depression. Banks now face stress tests, higher capital requirements, and the Volcker Rule banning risky proprietary trading. Lehman's ghost still haunts Wall Street. It proved that some institutions really are too big to fail, and that failure has consequences for everyone. December 2008. Just months after Lehman's collapse, another bomb dropped. Bernie Madoff, respected Wall Street veteran, former NASDAQ chairman, philanthropist, confessed to running the largest Ponzi scheme in history. For 17 years, Madoff had been paying old investors with new investors' money. He fabricated trade confirmations, account statements, even tax documents. His returns were impossibly consistent, 10 to 12% annually, regardless of market conditions. The red flags were everywhere. Financial analyst Harry Markopoulos warned the SEC 5 times starting in 2000. They ignored him. When the 2008 crisis hit, investors wanted their money back. Madoff couldn't pay. The scheme collapsed, revealing $65 billion in reported losses, though the actual cash was closer to $20 billion. Holocaust survivor Elie Wiesel lost his life savings. Charities shut down. Retirees lost everything. Madoff got 150 years in prison. He died behind bars in 2021. But his legacy? The SEC overhauled its whistleblower program, now offering rewards up to 30% of recovered funds. They created the Office of Market Intelligence specifically to investigate tips like Markopoulos's. One man's greed forced regulators to finally start listening. 4 scandals, 4 centuries, one terrifying pattern. Enron taught us that executives will lie when the incentives reward deception. The South Sea bubble proved that speculation without substance always ends in disaster. Lehman showed us that complexity can hide catastrophic risk. And Madoff revealed that even obvious fraud can thrive when regulators refuse to act. Notice something? We only fix the system after it breaks. We're always fighting the last war. Sarbanes-Oxley came after Enron. The Bubble Act came after the South Sea disaster. Dodd-Frank came after Lehman. Enhanced whistleblower protections came after Madoff. Each scandal exposed a weakness. Each reform patched that specific hole. But the foundation remains the same: trust. And when trust breaks, economies collapse. Here's the uncomfortable truth. The next financial scandal is already brewing. Maybe it's in cryptocurrency, where billions flow through unregulated exchanges. Maybe it's in AI-driven trading algorithms that no human fully understands. Maybe it's in shadow banking, the $65 trillion market that operates outside traditional oversight. History doesn't repeat, but it rhymes. The tools change. The scale increases. But human nature? That stays constant. Greed, ambition, the belief that this time is different. The question isn't if another scandal will reshape finance. It's when, and whether we'll finally learn the lesson before the dominoes fall. What do you think is the next financial time bomb? Drop your theories in the comments. And if you want to understand how past financial disasters shaped our world, check out the next video on how greed bankrupted Britain. Until next time, keep questioning. Keep investigating. This is Financial Mysteries.